So we ran out of time on our last video, but we'll just keep going here. We're into the profitability ratios. Profitability ratios tell you how well you're managing expenses and how much return you're getting on your investment. So net profit margin, for example. Go to the dry erase board. I have the formula up here. Net profit margin is net income over sales. This is another one of those formulas we already saw when we did the common size statements. It just happens that that fits in this these financial ratios, but it tells you how much profit you're making per dollar of sale. So if you're making $100 of sales and keeping $5, you have 5% net profit margin. We actually saw what Coke had earlier, but let's do it again here. Coke's net income is $9,244. Their sales $49,000. Which, if we write that out and then solve for it, that is 18.7%. Which means they're keeping about 19 cents on the dollar. Operating profit margin just uses, instead of putting net income on top, you put operating income or operating profit on top. So it'd be operating income over sales. Let's go look at Coke's. Their operating income $12,744. Again, their sales are $49,360. And then run that ratio. It's going to be a little higher. It's 25.8%. It's higher because we haven't taken out interest and taxes. Interest and taxes we kind of think is out of the direct control of management. Certainly taxes are. Management can't control their taxes. But interest also, we try to break up the financing decision and the operating decisions. So if a firm decides to finance themselves with a whole lot of debt, well, they're going to have a whole lot of interest to pay. But that doesn't necessarily affect the operating decisions, which is what businesses are we going to go in, how much sales are we going to generate. So when you take out interest and taxes, you get maybe a little bit better picture of how well the operations of the business doing outside of the financing decision. So it kind of takes that out of play. All right, these next two, return on assets, return on equity, they have to do with how much are we generating per dollar we invested. So the formula for, say, return on assets is net income over assets. So it's looking at our total amount we invested. So per dollar we invested, how much should we make? So it's a return number. It's going to give us a percent that says we're making X amount return per dollar. Let's go look at Coke's. Their net income was $9,244. Their total assets were $86,654. That's going to come out to 10.7%, which means per dollar they invested in total, the whole firm, they're making about 11 cents. You can take that and compare it to other possible returns. Could they have made more if they had just invested in corporate bonds or something? So you want to take that number as comparable to other types of investments. What kind of return are you getting? Now that's on the total assets. The equity holders or the owners only really care what they're getting on their particular investment. And if they have leverage, which means they've borrowed money, they're levering up their return, they're going to make more than 10.7%. The formula for return on equity is net income over equity, not assets, because they want to know how much are they making per dollar they put in, just the owners, not the amount they borrowed, which was put in by somebody else, because we've already taken that out when we took interest out of net income. Sometimes when you calculate return on assets, you add interest back in net income, because that's a payment out to the total asset holders, because the debt holders are kind of asset holders. But standard way is not to take it out, just to do it like we did it in the previous problem. It's easier. But on this one, this sometimes is considered the bottom line. This is the ratio that is the most important ratio, because it tells you as an owner how much I'm earning per dollar I invested. So it's really a kind of a bottom line measure. Let's go look at Coca-Cola. Net income again is 92,444, but now we're only going to divide it by total equity, which is only 33,210. If you divide those two numbers, you get 27.8%, which is higher, obviously, because they have a levered up return. The more leverage you take, the more your returns are relative to total assets returns. But on the flip side, let's say return on assets had been negative 3%. Return on equity would be more like negative 15%. So when you leverage up, you get more of whatever the return on assets get. So it's higher return on average, but it's also higher risk. You get more on a good economy, but you get worse in a bad economy. That's what leverage does for you. All right, these last two ratios have to do with stock prices. So if we were actually going to invest in this company, what kind of return are we going to get? These are very basic. There's innumerable number of stock type formulas and stock. You can watch CNBC or read any kind of business news, and they're going to give you all kinds of ways to decide whether or not you should buy a stock. These are just the two most basic ways to decide: is a stock cheap or expensive, is it a good buy? And these are kind of the two most basic, and everything else is kind of built off of this. So let's start with the what we call the PE ratio, the price to earnings ratio. So here's the formula for the PE ratio. It's the price per share, which is just the stock price. So if you go look up a quote of Coca-Cola, it'll tell you this is how much you have to pay per share. And then you divide it by the earnings per share. Earnings is the same as net income. So you take the total net income for the company, you divide it by the number of shares, you get the earnings per share. You divide this to, and that tells you the ratio of how much you're paying for how much earnings you're getting this year. The higher it is, the bigger it is, you're paying a larger premium for the same amount of income. The lower it is, the cheaper the stock is. The higher it is, the more expensive the stock is. It just takes away, it's a way to take the stock price and sort of normalize it to how much each firm is making. So if we go look at Coke, I've given you down here some per share stuff. Like I gave you the current stock price for Coke is $37.30. It's probably changed since I made this spreadsheet, but when I made the spreadsheet, that's how much it was. And I gave you earnings per share, and all that is total net income divided by shares outstanding. So if you divide those two numbers, you'll get the PE ratio. So I've written these two numbers up here. We're going to divide the two, and we're going to get 18.12. So you're paying 18.12 times the amount of earnings you're getting. Another way to think of that is, if they were earning $1 a year, it would take you 18.12 years to get your money back. If it stayed at the same amount every year, I guess I don't know if I explained that right, but that's what. Now that doesn't mean it's really going to take you 18.12 years to get your money back if you buy Coke, because this 2.06 is probably going to grow each year. The PE doesn't take account of that. The PE is just a basic way to say how much are we earning this year versus how much are we paying. And you can take this and you can compare it versus stocks, you can compare it versus the market in general, versus the industry in general, and things like that. It is one way to do this is flip it upside down. Instead of doing 37.30 divided by 2.06, take 2.06 divided by 37.30. If I did that over here, This equals, let me get my calculator, about 5.5%. Meaning you're earning, it's called earnings yield. You can write that in here somewhere. Sorry, my dry erase board's not perfect. Earnings yield. The 5.5% actually is a decent way to measure what your long-run return would be on this company. Just because the return on equity was on the order of 23% or whatever doesn't mean your return on a stock is going to be 23%, because you're obviously paying much more for the company than it's actually earning. So because you're paying more, actually the market to book ratio is an easier way to explain this, which is the next ratio. Let's look at that, and then we'll come back to this. So the last ratio, and we'll be done. I don't know if we'll talk about DuPont analysis or not, but the market to book ratio, instead of taking the price per share divided by earnings per share, you take price per share divided by book per share. Book is equity. So here's the formula. Market to book is price per share divided by book per share, which is the same as saying equity per share. The equity in Coke was earning on the order of 23-24% a year. But if you're paying a higher multiple than 1, you're going to get a less return than 23. So what markets do is markets set prices to where the return is equal to other investments. So if the rest of the economy is returning 10% a year, even though Coke is returning on their equity 23% a year, it'll sell at a premium, so when you buy Coke, you're only going to get 10% a year. There's no freebies in the market, right? So just because one company is returning more than the other, their stock price will trade for higher, and then you'll get the same as you would with any other investment. That's kind of the way the markets work. They funnel money. Prices go up for the companies that are earning more than others, and prices go down for the companies that aren't earning as much as others. Let's go look at Coke real quick. Price per share is $37.30. Their book per share is $7.40. So I've written these out, and that equals 5.04. So you're paying 5 times the equity value of the company. The equity value, the book value, is how much money was put into the company, either by raising cash through a stock offering or by retaining earnings in the company. So the company made money and kept it within. But the stock price is selling for much more. The stock price varies all the time, up and down. It varies. The book value is set in stone. It's however much money they put into it. So there's no reason that the stock value has to be equal to the book value. And most of the time it's higher because companies add value. As long as you add value, then your stock price should be higher than your book value. Alright, let's real quick, to end this lecture, talk about DuPont analysis. DuPont analysis is just a way to summarize a lot of these ratios into one standard model. So here's the DuPont model. It says it breaks return on equity, which I mentioned is sort of our bottom line number. Not our bottom line number is maybe price to earnings ratio, but if you're looking just at the company and not looking at market values, if you're looking at, so if you're an internal manager of the business, return on equity is sort of your bottom line number. It breaks it into 3 other numbers. It breaks it into net profit margin, asset turnover, and what we call the leverage ratio, which is assets over equity. It's the flip of the debt. Well, it's not the flip. It's related to the debt ratio, which, if you do the math, if you write them out, return on equity is net income over sales. Net profit margins, net income over, or sorry, net over sales. They all cancel out and you get the same number. So DuPont analysis says you can track these 3 numbers to figure out why return on equity changes, basically. All right, I don't have time to mention anymore. I will see you at the next lecture.